Housing prices are higher than ever, making home affordability a big issue for the average buyer. Until recently, home buyers looking for a more affordable option looked at condominiums, but with condo lending becoming increasingly harder, that's no longer the case. However, Fannie Mae has recently made it easier to purchase a multifamily property by reducing the minimum down payment required from 25% to just 5%. Opening the door to the average home buyer. So what is a multifamily property? A multifamily property is any property more than one unit. Now, with residential financing, which is what we do, it's a 2 to 4 unit property. So a duplex, a triplex, or a fourplex. Now, what are the benefits of owning a multifamily property? Well, pretty simple. You can collect rent on the units you're not living in. You can actually use projected rent toward qualifying. So as an example, let's just say you were planning to buy a 2-unit property or a duplex, and you're gonna live in 1 unit, and the second unit, because it's a 2-unit property, is what's gonna be rented out. When the lender orders an appraisal to determine the value of the property, on top of determining the value of the property, they're also gonna get an estimate of what the market rent will be for the unit you're not going to live in. Whatever that amount is, the lender can use 75% toward your qualifying income. So the benefit to you as a buyer of a multifamily property trying to qualify for a mortgage is that you can actually qualify for a higher purchase price than you would if it was a single unit property, because you have additional income. Although you're not receiving it yet, it can be used to qualify. So it's a great way to qualify for a higher price point than what you may qualify for on your own for a single unit property. Another benefit is that your primary home and the home you live in has also become an investment property for you. So it's not just your first or your property you live in, it's also could be your first investment property that you own. Now, here are some of the guidelines when you're buying a multifamily property. For one, as I said, you have to live in one of the units. This is only if you're buying as a primary, just to be clear. You can buy a multifamily property as an investment property as well. It's going to require a larger down payment. What I'm focusing on is the recent change to the guidelines allowing for just 5% down as a primary residence for you, meaning that you have to live in one of the units. You need to have at least a 620 minimum credit score. As we said, you need at least a 5% down payment. That can come from a gift. If you don't have your own funds, it can be a gift from a relative to help with that. You need a max debt to income ratio of 50% or less, meaning that your monthly gross income compared to your monthly expenses, including this new property, need to be 50% or less. Now, what's cool about these types of loans from multifamily properties is that they have higher limits that you're allowed to borrow. So there are specific limits based on the county in which you're looking to buy. On a single family home, let's just say in most of the counties in Florida, the most you can borrow on one loan is $766,500. However, if you're buying a 2-unit property, you can actually borrow $981,500. If it's a 3-unit property, $1,186,350. And if it's a 4-unit property, $1,474,400. Now, those are pretty high. You might not want to go that high, but just showing you don't have to go into jumbo loan territory, which requires larger down payments to borrow that kind of money, because the conventional limits will actually go that high when buying multifamily properties. Now, I've had realtors and other clients say, but why wouldn't I just do an FHA loan that allows me to put 3.5% down? Well, that's a fantastic question, because yes, you can use an FHA mortgage to purchase a multifamily property and only put 3.5% down. However, what you may not know is if you're looking to buy a 3 or 4 unit property using an FHA mortgage, it actually has to pass something called a self-sufficiency test. So let me explain how a self-sufficiency test works. A self-sufficiency test is where you can take the rent from all of the units combined, even the one you're planning to live in, add that together, multiply it by 75% because you have to factor in a 25% vacancy factor, and what's left over needs to be equal to or greater than the housing payment. So here's an example. let's say you're buying a 3-unit property, a triplex. For $600,000, you're putting down 5%, which is $30,000, meaning you're borrowing $570,000. On an FHA loan, you have something called an upfront mortgage insurance premium, which is 1.75% of your base loan amount. So if you multiply 570,000 times 1.75%, it's another $9,975 you have to add on top of your loan. So your actual total loan amount is $579,975. At an interest rate of 6.5%, your principal and interest is $3,665.84. But you're also going to have mortgage insurance. So you have to add another $237.50. You're going to have property taxes. Let's call that $600. You're going to have homeowners insurance. Call another $300. So we add the mortgage plus mortgage insurance plus taxes plus insurance, and we get a payment of $4,803 per month. That means to pass a self-sufficiency test, the rent from the 75% of all 3 units being rented needs to equal $4,803 or more. So, does it? Well, let's assume each of the units would rent for $1,800 per month, including the unit you're going to live in. 1,800 times 3, it's a 3-unit property, is $5,400. $5,400 times 75% is $4,050. $4,050 is less than $4,803, and therefore the property would not pass the self-sufficiency test, and you would not be able to use an FHA mortgage to purchase it. And no, it doesn't matter that you may not need the rental income from the accessory units to qualify. This rule applies whether you need that rental income to qualify or not, which is why FHA financing on a 3 and 4 unit property has become increasingly difficult with higher interest rates in this market. When rates were lower, yes, it was a little bit easier. However, now it's simply not the case, which is where the Fannie Mae's 5% down multifamily financing is the much, much better option. Now, we talked about why FHA wouldn't be a great option and why this is a better option than the FHA multi-unit financing. Here's another cool thing when it comes to multi-unit financing and multi-unit properties. House hacking. You might have heard that word. Your tenants are actually paying your mortgage for you, right? You're going to live in one unit. You're going to rent out the other units. So let's see an example of this. Let's just say that you qualified to buy a $250,000 condo because you said, you know what, that's all I really think I can afford. It's hard to find a single family home in most markets for that price. So that's really what's affordable to you. Well, we know that a condo is attached to all the other units next to it and above it and below it, right? So clearly you're okay living in a property that's connected to your neighbors. So why not live in a property that's connected to your neighbors where you're actually getting paid by your neighbors, right? That's where a multifamily property comes into play. So a condo, here's the example, $250,000 purchase price with 5% down, 30-year mortgage at 7% interest. Your principal and interest, $1,580 per month. Your taxes, $250 per month. Insurance for the interior, $80 per month. Mortgage insurance, because you're only putting 5% down, $125 per month. Condo fee, your association fee, $275 per month. So your payment on a $250,000 hypothetical condo with 5% down is $2,310 per month. Now let's compare that to you buying a 4-unit property, a 4-plex. Well, we know you go higher because you can use the rent to help qualify. So you're buying a $600,000 4-plex with 5% down. 30-year fixed rate mortgage at the same 7% you were getting on your condo. Principal and interest, $3,792. You might say, oh my God, that's much higher than the principal and interest on a condo. I agree, it is. But listen, you're gonna pay taxes of $600, insurance of $300, mortgage insurance of $300. No homeowners association fee because it's a multifamily, it's not a condo. Your payment is $4,992. See, it's much less than $2,310. I'm just kidding. Obviously, I know that's more than $2,310, right? However, what we need to factor in is that you're going to collect rent from the 3 units that you're not living in. So let's just say that each of those 3 units rents for $1,200 a piece. $1,200 times 3 is $3,600 that you're collecting from the 3 units you're not living in. Take your $4,992 payment on your fourplex, subtract the $3,600 you're collecting in rent, and your monthly net payment on a $600,000 property, which has many more advantages than just the fact that you're paying less, is only $1,392, which is $1,000 per month savings versus what your payment on a $250,000 condo would be. So if you've been struggling to purchase a home due to affordability issues, multifamily may be the right option for you. Leave a comment below with any questions you have when it comes to financing these types of properties, and I will respond to 100% of them. Also, make sure to subscribe for more mortgage and real estate videos just like this one.